Okay, Mihir Vora joins us. Tell us where markets are headed.
I think, Nikunj, we had this good correction for five months, and we had a smart bounce back. The correction had some reasons, and maybe to some extent it was overdone. So that overdone part is probably done. So we've had the reset, I would say. I call it the reset in the market, both in terms of valuations as well as in terms of some of the self-inflicted fundamental factors like RBI keeping liquidity tight, government going slow on spending in the first half, those are now getting unwound. So we have a good base of valuations and growth outlook to work from. And I think as we speak, apart from the uncertainties that you are discussing regarding the President Trump's actions, etc. For India, I think the base is reset, and we should be now looking at more normal kind of markets, barring unforeseen events in the global situation.
Okay. So markets are oversold, they've come back. Valuations were expensive, they've corrected. But earnings are not going to come back. So what happens to the market? I mean, earnings will take some time before they normalize, maybe 2 quarters. And markets have already come back. So then are we in for a pause phase for 2-3 quarters?
No, because you might be surprised, because if you notice, government spending has really gone down in the June 24 and September 24 quarters. And that was a big drag on the overall, economy as well as different corporates' results, etc. So we actually have a low base to start from in the June and September quarter. So on a year-on-year basis, things won't look too bad actually. So I'd be surprised if we don't see some upgrades in some of the stocks, especially in the cyclicals, because expectations are running too low at this point in time. So I would say that for the full year, of course, we are expecting the large cap indices to have earnings growth of about 9-10%. The small cap and mid cap index is probably 15-17%, 15-17%. So I think those earnings in the coming year, FY26, are expected. But you actually might have a surprise in the first 2 quarters.
Mr. Vora, the shareholders are joining in the conversation. And let's actually shift focus now to sectors, given the fact that now everyone is trying to actually spot that opportunity in the market. Though everyone is saying the banks is an outlier, it is out there actually for you to go ahead and pick this one, given the fact that with the correction, the valuations have become reasonable. But are you of that same camp that banks are looking attractive? And apart from banks, which one are you liking?
Certainly, the large banks and large NBFCs can't be ignored in this market. Valuations have corrected, and they've corrected not only in the last 5 months. If you remember, banks and NBFCs, the large banks and NBFCs had underperformed actually almost for 1.5-2 years. And that was with good reason. Credit growth was coming down, liquidity was tight. RBI was telling some of the large NBFCs to take it easy on the unsecured loans. Also, there were structural and fundamental reasons for the slowdown, and we did see a good significant derating of the large banks and large NBFCs. All these factors are now getting adjusted upwards. First, you have a low base to start from. RBI is getting dovish. Liquidity is being provided. The interest rates are being cut. Government spending, which was a drag, is now coming back. So all those sectors, all those factors, I think, will continue to help the economy. And if we assume that we meet our 6.5% GDP growth target for this year and next, which is FY26 and FY27, then credit in the system has to grow. We are running at almost only 10 to 11% credit growth for a country growing at 6.5%. That's not possible, because for the industry to really grow, you need at least 1.2, 1.4 times credit growth to GDP, and we are talking about nominal. So credit growth has to come back to 13-14% in the next few months. And we have a good base to start from. So financials, both from the terms of growth as well as in terms of valuations, are looking quite attractive, I would say.
Okay, so Mir, then it comes back to some themes where you think that we are in for an earnings surprise. Last year, that theme was largely where we got a lot of earnings surprise was PSUs, Defense Railways. Which are the themes for FY26 where we are in for an earnings surprise? Where markets are expecting 10%, we may get 12. Where markets are expecting 12, we may get 15.
So actually, the cyclicals which you talked about, the construction, capital goods, defense, railways, etc., started off with a lot of expectations last year, and then as the ordering, etc., got delayed, we saw downgrades, and now we are at at levels where people are not expecting much. But in the last few months, a couple of months, we have seen that ordering has come back. So in these cyclicals, again, I think we should start seeing upticks. You might see some upticks in some of the discretionary names, FMCG names, if you really see inflation coming down and metal prices coming off. So we've had situations where in the last couple of months, steel prices have gone up. So there is some expectation building up of margin pressure. But if that does not come through, then you again might see some of the discretionary names also, getting better in terms of margin. The other place I would look for probably in the second half of FY26 is financials. As liquidity starts easing, and if the RBI decides to keep liquidity even more easy than what it is now, then you might see further upgrades in the financials sector.
Mir, there is a lot of this entire consumer, what should I say, demand vector at play now, because from 1st of April, we will have that tax saving kicking in, right? Government announced in the last budget, but the tax saving in hand of taxpayers will only start kicking in from 1st of April, from April onwards, when we will get an April salary, we'll say, come tax laga, right? How will that affect markets? How will that affect stocks? Mir ko doesn't matter, kya 10,000 tax mein doesn't matter to me. Right?
Every bit is welcome.
Right. I know it, it's okay.
Every bit is welcome. But I think the direct impact of the tax cuts may not be very visible immediately because, as I think we discussed in the past, part of it will actually go to savings and deleveraging also. There is this middle class, leverage that has happened. So part of the money might go for deleveraging. Of course, part will go for consumption. So I don't see an immediate, visible kicker, though it's a net positive, but it won't be that sharp for us to really pinpoint that this was exactly due to tax cuts.
Right. Mr. Vora, coming to the sectors, I wanted to get your view, especially on the auto space. Today, you have the auto sector that is in focus on back of what Trump has announced. But keeping that the news piece aside, how are you gauging the entire auto space? And when you talk about auto space, also I want to get your view on auto ancillaries.
Sure. So in general, we are not that positive on auto because commercial vehicles, there's not much volume traction. Passenger vehicles, again, there's not much volume traction, but there's a couple of names in our portfolio which are doing better because they have a good, SUV or MPV kind of a basket. That's which is growing faster. But in general, passenger vehicle growth is not expected to be more than 3-5%. Two-wheelers, again, there is a little bit of traction compared to the low base that we have, so we are a little positive there. But if you see, two-wheelers growing at maybe 8-9%. Cars probably at 3-5%, commercial vehicles also not showing growth. So in general, the situation is not that great. Within the two-wheeler space, there is no case for looking at the premium names, the higher end names, because that's the trend that we've been seeing consistently, that the higher end specs vehicles, whether it's SUVs or two-wheelers, bikes, etc., are doing better. So those kind of names we are positive on. But overall, I would say we are underweight. Auto ancillaries is a mixed bunch, and we have a good, small cap, mid cap spectrum to choose from. And there are many interesting companies which are doing extremely well in spite of the overall pie not growing so well. So they are expanding their product range, they are expanding capacities, they are also going for exports. So we have 3 or 4 stocks in our portfolio in the auto ancillary space, which are doing things differently to basically make sure that they are not that directly impacted by the slowness in the industry. So these are stocks where we can see that there is earning visibility for the next 2, 3, 4, 5 years, even without the assumption that the sector will grow. So those stock picking opportunities are there in the auto ancillary space.
Do you see your top 5 holdings changing in next 12 months?
Sorry, could you repeat that?
Do you see your top 5 holdings, which is a combination of banks and other consumer names, do you see that changing in next 12 months?
No, I don't think so. We are basically growth investors, and I do firmly believe that the domestic cyclicals will continue to do better than the exporters. So we are underweight on large cap IT. We have some mid cap IT picks, but in general, IT is underweight for us. Commodities, energies is underweight for us. Most utilities are underweight for us. And we are positive on the financials, including capital marketplace, and most of the industrials like construction, capital goods, and the subsegments like defense, etc. Power is a big theme for us. Within healthcare, we are more positive on some of the CDMO names, some of the laboratory names, and a couple of hospitals in the range. So I think we are going to be be We will continue to be positive on the healthcare space, whether it's CDMO or diagnostics of hospitals, and we'll continue to be positive on industrials like capital goods, construction, defense, etc., power that we talked about, and financials. I think both the segment, lenders as well as non-lenders. In non-lenders, we have the capital marketplace, etc. Those are also looking interesting because all these segments have really gotten beaten down in the last 3-4 months.
All right then, Mr. Vora, we leave it there. Thank you so much for joining us on the show this morning to give your views on the various sectors that you're liking, also the sectors that you're not liking at this point in time, given the fact that you mentioned that you don't see a change in your portfolio going ahead. Thank you so much for being a part of the show.
If you like this video, then like, share and subscribe to ET Now.